Hey everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And one of the things I like to do with this YouTube channel, and I do it as much as I can and from time to time, is what I call subscriber request series. Subscribers to the YouTube channel ask me to cover certain companies, and in some cases certain sectors or industries. And one of the subscriber requests that I did in January of this year, which of course was just prior to COVID, was I covered the 3 primary oil and gas integrated companies in North America. And that was done just before the crisis came. And, there were some very interesting dynamics there. One of the things I tried to point out is that when you're looking at stocks in the stock market, you're looking at one sector, you have a tendency to see all companies in that sector look the same. So this was the video I did in January. You guys can find it. It was, I covered CVX, Imperial Oil, and Exxon. And I do want to just show you what these companies look like. Here's Imperial Oil at that time. And then, of course, finally here is what Chevron looked like. This was operating cash flows, which I'll kind of get into in this video. This is what Exxon looked like. That's a shorter view. See if I can give you a longer view of Exxon. Well, without trying to go through all this and show the old video, I do want to come back and revisit this. A couple of things I want to point out, as I did in the first video, is that number one is the industry itself is in turmoil. So, oftentimes you'll find great disparities between individual companies, even in the same sector. But here you've got almost all companies suffering through the same type of carnage, which of course is, collapsing oil and gas prices. We all know what's happened, and then now that's been exacerbated by COVID. In the previous video, I did show that we were looking for some really nice recovery in the oil and gas industry at that time. But today, what happened was COVID came, and of course, people quit driving their cars. Businesses had to shut down. We all know the story. I'm not going to belabor that. But the point is it had an extra jolt on the oil and gas companies, or the integrated oil and gas companies. And, so we saw this big collapse in earnings subsequent to that, where earnings fell from $2.25 to a negative 23 cents expected for this fiscal year, which ends, in December. But then the analysts are expecting a recovery going forward, but this recovery looks a whole lot different than it did when I first covered this. And then, the same would be true of Chevron. And again, you're going to see a very similar graph here. Chevron also had a huge earnings collapse as a result of COVID. So it went down to a negative 28 cents, but it is expected to have a recovery. The similarities here are what I'm really trying to showcase at this point. And then also Imperial Oil had a very similar picture where at the time these companies looked like they were going to improve and things were starting to improve. And then, of course, since COVID came along, then we've had this additional collapse. And Imperial Oil, although very similar to what I showed you with the other two, it has even more dire prospects. Now, in the process of doing this, I've been really asked more about Exxon than any of them, but part of the subscriber request series here was to cover, so I thought I'd go ahead and try to kill, a couple of birds with one stone here and go ahead and look at Imperial, revisit Chevron as well as Exxon. But then I also had requests for some of the other integrated oil and gas companies, as well as additional companies that weren't necessarily integrated oil and gases like Marathon. And one subscriber said they actually preferred these companies. Well, they've had some really severe drops. Marathon, which is actually an oil and gas refining and marketing company, it had significant deterioration, as you can see. We're going to have at least 2 years of negative earnings growth before we see any recovery. My original article was covering North American. So, Royal Dutch is obviously not a North American, it's a United Kingdom company. But it had a very similar picture. The operations look, very similar in terms of what's happening to oil and gas. But I do want you to notice Royal Dutch did cut their dividend. The white line you see on the graph here is the dividend. And I do want you to notice earnings weren't necessarily covering the dividend, but they actually slashed their dividend from $3.76 in 2019 to $1.28, and it's not expected to start growing again until 2022. So, that was a problem for them. And then I also was asked about British Petroleum, which, again, is not a North American integrated oil and gas company, but it's another United Kingdom company. And again, we see a very similar picture. We see these very significant decreases in the company's operating results, over these historical time frames here. Since the Great Recession, oil and gas companies have really been in a downturn, and BP also cut their dividend. So, we've had some dividend cuts here, but the real focus here has always been with me, it's been on cash flows. Do these companies have the cash flows that can continue to support their dividends? And in most cases, the answer to that question is still yes. However, the cash flows have deteriorated significantly from what they were. But now, in the case of BP, their cash flows definitely deteriorated, but again, they decided they would cut the dividend. So let's go through just some of these other companies. I'm going to do them here in alphabetical order so it's easier for me to do. I want you to notice that Chevron is barely covering their dividend with operating cash flow now. Their operating cash flow payout ratio has increased substantially, and you can see that it's up here at 73 or 74%, where a couple of years ago it was only 28% of operating cash flow. So there is stress on the company's cash flows, but they're still covering their dividend. Imperial Oil, which is the Canadian version of the North American, they're really barely covering their dividend. In fact, they're not covering it. They earned 85 cents in operating cash flow, paying a dividend of 88 cents. But they have also, so far, analysts are expecting their dividend to be frozen for at least the next couple of years. But we're seeing this continued deterioration in some of the important metrics. Now, what has made these companies attractive, they've not really performed very well, any of them, if you kind of notice, from a standpoint of price performance. As far as capital appreciation companies, the attraction here has been the dividends and the dividend growth of these companies. And you can see Marathon is, no longer covering their dividend. And, I just keep going through these on operating cash flows. So what's happened is COVID has really exacerbated an already bad situation. And I'm going to say pretty significantly, to where these companies are seeing a great deal of stress from the normal state of their industry, but they're also seeing the impact of the hopefully temporary situation that happened with COVID, and that's hit them harder and hurt them a little more. So, these companies are still viable businesses. They still have high credit ratings, like the case of Exxon, it's AA rated, has only 18% debt on the balance sheet. So the companies are still reasonably strong, but again, there's been no performance on these stocks from a standpoint of capital appreciation now for quite some time. So let's look at Exxon, for example, going back to 2014, and we see that $10,000 investment would have shrunk to $3,200, and even though they paid a nice dividend, you still would have had a 9% annualized loss. So oil's been really dead money for quite some time here. What attraction there has been all about the dividend. You've got a very high dividend yield on Exxon now and some of these other companies, but there's an awful lot of risk in here. So it's an industry that is suffering kind of universally based on the dynamics of what's going on in the industry. And there are individual companies within the industry that are doing, worse than others in the industry. But there's really some trouble here. But so if I look at another perspective, if I look at a company like Exxon, and now I'm going into fund graphs here, the red line on this graph is cash on the balance sheet. I do want to make that clear, cash per share on the balance sheet. And then the green line here is dividends, the actual dividends paid. And what I want you to notice is for really all the way up through, you can actually push this little bit through 2012, Exxon had more than ample cash to cover their dividend. But since that time, their cash has been depleted as a result of all the things that I've showed you, including stresses on their cash flow generation, and they're no longer covering their dividends with cash. However, it's not all bad news, because even though they're not covering it with cash, if I do look at their, as I already did, if I look at their operating cash flow, they are covering their dividends with operating cash flow. So, there still is hope, I guess you could say, for this industry. I'm not going to go through all these companies here, again, just for sake of brevity in this video, but I do want to point out that this is an industry that is going through some real serious issues. I don't know if it's for the faint of heart. The dividend yields look attractive. Again, some of these companies have already cut their dividend. It doesn't look like Exxon or Chevron is in any jeopardy of maybe doing that themselves, but it's not just, it's not a giveaway. In other words, there's still, a very strong possibility that if things don't turn around for this industry, that these companies could face greater weakness. So if I was going to look at the integrated oil and gas companies, you can be attracted by their low multiples, trading at 7 times cash flow here with a blended cash flow yield of over 14% and a dividend yield of over 10% in the case of Exxon. But, you're not looking at a normal scenario here. These companies are struggling. The oil and gas industry is under a great deal of stress. There's political risk. There's, market risk, environmental risk. There's so many things facing this industry that, again, I just don't necessarily believe it's for the faint of heart anymore. Cash flows still seem to be okay, but I'd be very, very careful investing in these companies. Again, performance for all of them have been relatively weak. Chevron's done a little better than Exxon in what I showed you here recently. But again, the dividend yield's a little lower. It's AA rated, as we saw with Exxon. But again, I just don't know if there's a lot of real opportunity in the oil and gas industry unless you are a strong believer that the industry is going to recover and recover strongly over the long term. Chevron's operating cash flows are expected to recover. Long-term growth, we're getting negative potential long-term growth. So all in all, there's a great deal of risk in this industry. I'd be very, very careful here. I would do my homework. I would tread carefully. And if you do decide to put some money into any of these major integrated oil and gas companies here, I would also suggest you watch them real closely. And I'm not talking about the price. Price volatility is something that's pretty unpredictable. I'd be focusing on their cash flows. I'd be focusing on their businesses, what the management teams are doing. I'd be carefully scrutinizing their annual reports as they're published and trying to pay attention to the business, because ultimately it's the business behind the stock that matters most. Anyway, this has been Chuck Harneveld. This is a subscriber request series, so I did want to kind of update everybody on what these oil and gas companies look like today. You got to be very careful. But if you like the video, please subscribe to the YouTube channel if you haven't already. Give me a like. I always appreciate those likes. Anyway, thanks for watching. I'll talk to you again real soon.